The objective of investing in shares is to make a return. So in this webinar, we are going to discuss how you can measure the return on an investment. The return on any investment is broken down into two elements: income and capital gain. The capital gain is the difference between what you pay for an investment and what you sell it for. Some investments, like fixed interest investments at the bank, have no capital gain at all. Others, like Krugerrands and commodity exchange-traded funds, offer no income. The income investments offer varies. For example, you get cash on fixed deposits at the bank, and they pay interest. Property pays rent, and shares pay dividends. The best way to explain return is with a simple example. Let us suppose that you buy some shares for 1,000 cents each, and then sell them 6 months later for 1,100 cents per share, after your dealing costs. Then you will have made a capital gain of 100 cents per share. And let us say that you get a dividend of 50 cents while you are holding them. Then your total return will be 150 cents, made on an initial investment of 1,000 cents, so you have made a 15% return. But you have made that return in 6 months, so we need to annualize it, so that it is comparable with other investments. So your total return in percentage terms is 30%. Then, of course, you need to allow for taxation, which will depend on the tax bracket that you fall into. But let us assume that in this case you end up paying 20 cents of your 150-cent return in tax. That means that your annualized after-tax return is actually 26%, 260 cents made on an investment of 1,000 cents over a year. Now we also need to take into account inflation. Let us assume that inflation is approximately 5% per annum. So now your after-tax real return is 21%. In other words, 26% minus 5%. Is that the whole story? No, not really, because every investment also involves a level of risk. The problem with risk is that it is almost impossible to measure, but it is definitely there, and you need to take it into account. If there are two investments which have the same return, investors will always choose the one which they think has the lower risk. Or to put it another way, when there is more risk, investors must be offered a higher potential return to get them to buy. As a private investor, you must always try to make sure that the potential return which you make from an investment is enough to compensate you for the risk that you are going to take. The higher the risk, the higher the potential return. Of course, you can always reduce your risk in an investment by doing your homework on the company concerned. As we said earlier, some investments offer no income at all, like commodities. Krugerrands, for example, don't pay any interest, rent, or dividends, and they don't add 10% to their weight every year. The only reason that people invest in Krugerrands or gold exchange-traded funds is that they hope to make a capital gain. Or perhaps they are looking for the security that gold offers. Gold is the most secure investment that you can make. It protects you against the weakness of paper currencies. 1 ounce of gold would buy you the same number of chickens today as it would have bought you 5,000 years ago in Egypt. If we ever have a third world war, when all the paper currencies and other paper assets are worth nothing, gold will still probably buy you the same number of chickens, albeit mutated. The purchasing power of gold has not changed throughout history. When the man on TV says that the price of gold went up or down in US dollars, what he really means is that the US dollar rose or fell against the value of gold. But the value of gold is more or less a constant. Fixed interest investments in a bank offer no capital gain, but your capital is still subject to the ravages of inflation. So you might be getting an 8% interest rate on your cash, but you will have to deduct the inflation rate of, say, 5% in order to arrive at your real return of 3% per annum. Shares, of course, offer both an income in the form of a dividend and a capital gain, especially if you hold them for the long term. In South Africa, capital gains tax is a factor, but it is much lower than income tax. If you are in the marginal tax bracket, then you are paying as much as 45% of your income in tax. Capital gains tax is only 16% of whatever capital gain you make. The problem is that if you hold your shares for less than 3 years, the receiver of revenue may declare you to be a share dealer. And then, whatever capital gains you make will be added to your income and taxed accordingly. But if you hold your shares for longer than 3 years, then you will definitely not be declared a share dealer, and you will only have to pay the 16% capital gains tax. So when you are considering a share, you should always ask yourself where you think that company will be in 3 years' time.